Okay, let's get started. Well, we fixed that that cover. Welcome to session 31, Central Bank Digital Currency, organized by the Bank of Canada. Today we have 4 papers with different aspects of the issues around central bank digital currencies. First, we're going to start with a structural estimation paper, Demand for Payment Services and Consumer Welfare, the introduction of a CBDC by Kim Hume from the Bank of Canada. Then we're going to move into a macro paper, Central Bank Digital Currency, Inflation Tax, and Central Bank Independence from Ohik Kwon from the Bank of Korea. Then we'll go into aspects of stable coins, what keeps stable coins stable, Ganesh Viswanath-Natraj from Warwick Business School. And then we'll look into platform economics, vertically disintegrated platforms, presented by Tarik Roukny from Catholic University of Leuven. So the ground rules for today will be a 25-minute presentation, and we're going to try to leave the questions, 5-minute questions towards the end. If you have a pressing need to have a clarifying question in the middle, do so, but we'll try to push that questions towards the end. So without further ado, please, Kim, go ahead. Thank you.
Well, thanks a lot, Francisco, and thank you for organizing this session, and thanks for everyone for joining. So the paper is Demand for Payment Services, New Product Introduction and Welfare. This is joint with Jozef Molnar, Alexander Shcherbakov, and Jerry Yu. Alex is at this session today. So everything I say in this paper is my views and my views only, and do not represent the views of the Bank of Canada. So as Francisco said, this is an empirical paper. And so the basic premise of this idea is that we are going to focus on the idea of what do consumers value in payment services. So this is focusing very much on the retail at the point of sale. So currently, what do consumers have in their current bundle? Well, there's always cash, there's some form of a debit card, and there's some form of a credit card. And so the idea is, well, suppose we were to introduce a CBDC. A very conceptual idea right now. There's a lot of discussions, debates on what form of CBDC it will have and what features. So we'll go through that and what these features of the CBDC is going to entail. And then we're going to do is have this hypothetical situation. We're going to introduce the CBDC. Then we're going to then simulate what would be the products, what would it bring to consumers, and then ultimately to improving their welfare. So that's the kind of high-level overview of the paper, and let's dive into it. So here's the motivation that we have. It's if we observe, I would say in the last decade, there's been a decline in cash shares at the point of sale. So the Bank of Canada, we've undertaken several what we call method of payment surveys. So the method of payment survey has this element of recording purchases by consumers over a 3-day period using a diary. And so with that, we can get very detailed transaction level data. And then we are able to calculate the volume and value share. So the volume share is the number of transactions, and the value shares is the dollar amount of their payments. So if we look at cash, we see that in 2009 is roughly half of all transactions in terms of volume, and by 2017 it's 33%. Value has been was 23 steady, and then in 2017 decreased to 15%. So this is the motivation where we are faced with, is that there's a decline in cash shares at the point of sale, We do know that cash or banknotes in circulation has been steady or rising in the past decade. But that's another story for another day. So today we're just going to focus at the point of sale, and we're going to focus on these retail payments. So here are some reasons positive why there's a decrease in cash at the point of sale, partly because of consumer demand. There's some demographics and stated preferences, and that there's also introduction of these new products such as debit and credit cards. Payment innovations, I'm sure that's in 2009, there was not much of a discussion of contactless credit cards or debit cards, but now they're almost ubiquitous in most jurisdictions. Even in the United States. Then there's this idea of Iraqi transfer. In a central bank or in this literature, there's always this discussion of swish in Sweden. Well, Canada has a very similar product. It's called Iraqi transfer. So you're able to make P2P transactions online just by using an email address. The second reason, well, we always think about there's the demand side and then there's the supply side. There merchants, there's been an increase in acceptance of cards. So, so we see that cash is almost universally accepted by all merchants. In terms of cards, it's almost universally accepted by all large businesses. So large businesses we define as having chains, or what the English say, high streets vendors. Cards are only, but we also ran a merchant survey. We found that cards are only accepted by 2/3 of small and medium businesses. So this survey was undertaken in 2015. And a very small amount of these small, medium-sized businesses did not accept cash. So these are what we call the push and pull of payments. And so we're going to, the model is going to use the data that on both consumer and merchant side to explain this. So I'll just skip this. So what are the research contributions? Well, one, we're going to answer the question, what are the main characteristics of consumer demand and usage of adoption of payment methods? And then we're going to go through the laundry list of factors. And then we're going to ask that once we have this, we built this demand model, we're going to ask that question, what would be the predicted usage of a hypothetical CBDC? And we'll go through three scenarios. We're going to create something that's very much like cash. We're going to have one that's very much like a debit card. And then what we're going to do is take the best of both the features of cash and debit and create a CBDC. So here is the results preview in case I don't get to it. We find in terms of CBDC usage, once you introduce this, it'll be able to capture 19 to 25% of the market share under the scenario of all consumers adopting and all merchants accepting. In terms of consumer welfare, this is going to increase by $2 a month for the average user under full adoption and acceptance. And there's going to be some distributional effects because certain segments are going to value CBDC much more than others. And what we find is also that the CBDC design will be very important. So in terms of transaction costs, how easy it is to use, and what is the acceptance by merchants. So those are the results. I'm just going to skip this. So to go dive right into the model setup. So what we've done is we've taken the model, two-sided markets, work I've done with Grady Nichols and Alexander Shcherbakov. We're happy to share the paper. It's in the public domain. And so the idea is that there's a consumer, and the consumer has to make a decision on what type of bundles of payment methods they have. Do they just have cash, cash and debit, cash, debit, and credit? On the other side is the merchants. So they must make a decision on both cash, cash, debit, and credit. So then what happens is very much like in our diary study, is that once we know what the adoption bundle is, then the consumers go shopping, and then depending on what the merchants accept, that's how they pay. So in this fully two-sided markets model, we have this whole machinery to understand this. So in this paper, what we're going to do is we're not going to have this. We're not going to have this full feedback loop in terms of the merchants, and I'll explain how we do that. So the idea is the buyer, the consumer knows roughly what the average acceptance by sellers. On the other side, the sellers knows what the expected adoption by each type of consumer. And as we said, there's going to be this consumer adoption merchant acceptance choice set between cash, debit, and credit in this bundles. So there's going to be this two-stage game. So the way to think about it is, as we said at the beginning, consumers and merchants make their decisions on what type of bundles they'll have, and then conditional on this, when they meet, then they'll decide how they pay based on costs. So one major assumption we're going to make is no matter what, people can always pay cash. So with this model, we'll focus on consumer demand and heterogeneity. So so let's focus on what we call the second stage. So the first stage is where the adoption and acceptance decision has been made. So we'll just park that for now. But in the second stage, what we call the discrete choice of the payment method, there's going to be this idea that, okay, well, what is going to determine payment choice? Well, there's going to be some type of payment method specific variables, such as how easy it is to use, what's the affordability of use, security of use, whether the consumer gets rewards, and what's the transaction cost. Then the diary also has various transaction-specific variables, such as the type of purchase, where it's at, what type of shop. Then we also know a lot about the consumer. We know their age, gender, income, education, marital status, employment, if they're Canadian born, and if they have a smartphone. So so remember, we're going to take everything about the merchant acceptance and consumer adoption fixed in the second stage. So as I stated before, the first stage, there's these adoption and acceptance decisions. And then what happens is that here is the form of what the maximization problem that the consumer is faced, right? Of consumer B, they've been given a shopping list, IB, at a given price, PBJ, which is completed. So it's like me, my mother gives me a shopping list, I go shopping, and then I have my wallet, I have all these payment methods. So what's my expected utility conditional on all the, what my bundle of payment methods? Well, it's going to be this, what the probability of the merchant acceptance, and conditional on this match between my adoption bundle and the merchants. What I'm going to do is there's going to be this set of characteristics that we discussed. So the one big assumption we're going to make is that it's going to be inelastic demand. All consumers must complete their transactions. So as we said, there's going to be this two-stage game. So in the first stage, there's going to be this adoption cost, or it could be a benefit. So there's going to be a fixed cost, you can see here, okay? And we're going to make some distributional assumptions around it. It's basically an ID draw from a standard Google, which will result in logit errors. So we're going to get this, from this, we're going to get a likelihood function. And so I'll just walk you through it very briefly. So these are the matches, right? The probability of this transaction J for cash, right? For this bundle, this transaction debits and transaction credit, and it's going to be multiplied by this these. So these are the probabilities of the bundles, and then in the matches, what would be each of the cases of the utilities. So this is an extremely complicated likelihood function. That's why we use simulated maximum likelihood. Okay, so I think now let's go into the data. So as I alluded before, there's a survey questionnaire, which will have very rich questions about what the portfolio payment options that consumer has, what's the perceptions and characteristics, their typical payment patterns and demographics. Then we're going to ask them to go shopping and then record over 3 days what their purchases are in terms of value, what the method of payment, and which business, and the type of purchase. So this is the survey part. And so to help us, what we're going to do is to understand, especially for adoption, is we're going to use the TransUnion credit registry. So since we have very rich features of the consumer, we're going to be able to basically impute from using the nearest neighbors and match to find out what the credit score for these consumers are. So let's go to this idea of what are the main features of that consumers value in a payment method. So in our survey questionnaire, we asked about ease of use, affordability, security, and acceptance. And we asked them to rank and these payment methods, cash, debit, and credit. And so for ease of exposition, what we're going to do is look at those who just adopted only cash, those who adopted cash and debit, and those who adopted cash, debit, and credit. So you can see for the majority, it's cash, debit, and credit. And then there's a very small minority that's just cash only. And you can see the differences, right? So for those who only adopt cash, the difference between cash, debit, and credit, you can see. So one means that's it's the highest ranked one versus debit or credit. You can see in ease of use, it's 1.88 and 0.85. So cash is number one, debit is 12% less, and credit is 15% less. When you jump to ease of use, for the full bundle, you can see that the differences are not that large. And then you can see very starkly when those who just have cash and debit, you can see that the cash and debit are very similar, but the credit is a very lower option, very much like in this bundle. So there's something with this bundle and this bundle, you can see that there's that they made the switch to debit. So these are what we call the perceptions, and that's what we're going to use in this model. We're going to find out, well, what are these stated preferences about from the consumer and that they value in these different bundles. And then what we're going to do is then take these features and then we're going to set them, we're going to simulate what would happen if we were to introduce, there's going to be a fourth column called CBDC that has certain features of these bundles. Okay, so here are the demographic profiles. You can see the cash only, age is about 45, not that much different, well, a little bit older for the full bundle, but the big thing is you can see income. in these two bundles, cash and debit, you can see that their income is about 44,000, whereas those who have a full bundle, you can see their income is considerably higher at $76,000. And you can see there's a bit of an education. Those respondents with a full bundle are highly educated relative to these other two bundles. And also in terms of smartphone usage and this idea of being employed in a certain sector. Okay, so here are the, just to give you a sense of what the payment shares are, you saw a decline in overall shares, but here are you can see in 2009, cash is very high for grocery, drugs, and entertainment and meals, and travel and parking. And you can see these shares are being eroded over time, right? In 2017, it's 47%, right? So for groceries and drugs, cash was the #1 in 2009, 2013, but you can see by 2017, credit's taken over. So you can see the decline in cash at the point of sale. So
5
here,
minutes, Kim.
yeah, thanks. So I won't go through all the estimates with you, but just to let you know that we find that in this case, in this full model, there's actually this idea that there are these features, right? That they're all very, so ease of use, affordability, security. Those are very significant. And then you can see what the fixed cost parameters are. So you can see that there's a cost to having cash and debit, but there's actually a benefit from getting credit cards because of this rewards features. And then what we're going to do is we're going to use the credit score, and the credit score is also very significant. So here's the average contribution. So you can see ease of use is very high in each one, and transaction costs is one of the major negative disutilities. So for debit, you have to pay for your debit card transactions, right? So with these features, I'm just going to skip to that. Okay, so this was the bundles we considered. Now, what we're going to do is we're going to expand the choice set. Okay, and what we're going to do is we're going to have this merchant acceptance. We're going to have some type of sensitivity analysis of either full adoption or not full adoption. So I think the best thing to do is just to go through one of the counterfactuals. So I think let's go to the best case scenario, or the best features of CBDC. We're going to make it very cash and take the best of both worlds of cash and debit, and then see what would happen. So everything that consumers value in cash that they really like, and then take everything that they really like in debit, merge those two together, and then what we're going to do is take those perceptions and then change those perceptions to mirror this. And so there's some caveats to this analysis. One, we're not consuming any competitive responses from banks and merchants. We do not take into account of possible digital or peer-to-peer usage of CBDC, right? Not having this online components. And we don't consider any potential new applications of CBDC, so that it could be used for smart contracts or programmable money. So let's just skip to the best features of CBDC with full consumer adoption and merchant acceptance. So this is the best case scenario. So this is the observed shares right now, 41, 34, 25. Then what we're going to do is we're going to design a CBDC that mimics the best of both cash and debit. And then we simulate those purchases, and then we say to the consumer, hey, there's this new feature called CBDC. It has the best of both worlds of cash and debit. What would be your payment choices given this new instrument? And we can see here under this, the ultimate, what we call the rosy scenario, 1/4 of the purchases will be undertaken by CBDC. And you can see that CBDC is going to take 14% of share away from cash, it's going to take about 8% away from debit and a bit away from credit. And this shows this idea of heterogeneity. And let me show you why there's some heterogeneity. So there is, in terms of, you can see that there's education. So by providing this best of both worlds, you saw that before cash and debit were used by lower income, lower education. So by that metric, those with who have lower educational attainment will value it more. So you can see the distribution in terms of the utility improvements. So we said roughly that it's going to be about $2 is the mean difference, but there are going to be consumers that will have a high benefit, and you can see those high benefits are going to be these educational attainment, and also some of the younger folks. Okay, and in terms of income too, so you can see the lower income has a higher benefit than we would say with higher income. So then we asked that question, okay, so we have this rosy scenario right here, which is 100% merchant adoption. What would be the effect if there wasn't fully acceptance by merchants of CBDC? So you can see if it's zero, well, of course, there won't be much CBDC adoption. But as merchant acceptance increases, you can see CBDC usage increases. And then by the time we get to 100% adoption, this is where you get this increase in CBDC usage. Sorry, this is for cash. I'm sorry, my apologies. Here's the best features for CBDC. So you can see this curve rising, right? And there's, by the end, it gets to about 25%. And then the decrease in cash and debit. And it's at the expense of cash and debit. So this is the probability of consumer adoption. So this is the other side of the coin. What would be the probability of adopting a CBDC conditional on what merchants would accept? So you can see in the best of both worlds, best of cash and debit, you're going to have a much higher rate of adoption if you were to create a CBDC that has best features of cash and debit. So I think I'll conclude there. Cash use, tend to be lower income in education. We find that transaction costs, ease of use, rewards, and merchant acceptance drive the majority of welfare from payments. And with the best of both worlds, CBDC can capture 19 to 25%. Where the welfare implications, well, it's going to skew towards these populations that are not using some type of electronic payments. And we see that the adoption and merchant decision is going to be very important. So I think I'll leave it there. So.
Thank you, Kim. So I think we went a bit over time, so I'll just open the floor for 1 or 2 questions. Anyone from the attendees? Okay, so I have a question. So if no one else does, and I'll just go to, I guess, and I think probably I've asked this question in another form earlier, but the fact that cash is always available as the baseline, how do you think, how relevant that is for both the welfare and the market shares that you estimate in the future when actually some merchants might not accept cash going forward, right? I think that might be an important assumption.
Yes. So the assumption is based on empirical data, and that is one of the reasons why we continue to monitor the situation by doing merchant surveys. So the last one in 2018 confirmed that is almost ubiquitous acceptance of cash at the point of sale. So there has been reports now that during the COVID-19 pandemic that there has been a decrease in merchant acceptance. So we did run a survey, and so merchant refusal of cash was at the height of or at the beginning of the pandemic was about 12%. But we did another short survey in July, and it's abated, and it's about 9% compared to about 5% and what we found in 2015. So in terms of the modeling assumption, what we would do is we could, and this is something we've been discussing in terms of this cash less bundle, is that we remove this option from the merchant. So when we remove this option from the merchant, then what would happen? Well, in most cases, transactions will clear because people will have some form of debit and credit, as we saw. But there's going to be a small minority that only have cash. So then what would happen is then those only with cash, they can't complete their transaction. So then they're forced to basically shop for a longer time, right? To find another venue that will accept cash. And so when we built that two-sided markets model, we had this idea of random search. And so it was, in terms of welfare, well, we would just say, well, you can't complete this transaction, go to the next store. But in the newer paper we have, where we have adopted directed search, we are able to delineate between those consumers who have a full idea of what merchants accept and what merchants, so merchants also knowing what consumers' adoption would be. So in this case, we can quantify then there's going to be this idea of uninformedness. So there's a cash user, right, that enters a store and they don't know that this place hasn't accepted cash. So they're going to face the shock. So then we would then quantify, well, what's the cost of that, them moving to another store. So this, the model, so we've rewritten the model, and in the newer paper, we'll take a look at that. But it is definitely, there will be this measure, and it's going to be a decrease in welfare for these consumers. So therefore, you could see, especially in the counterfactual simulations we have, that's one of the reasons why the lower educated poor, they would benefit from a CBDC, because then they have this option to that they can pay with. So
Okay, thank you for that. So I think in interest of time, let's move on to the next paper. Ohik, please, 25 minutes. Sorry, and one more thing. I was reminded to remind the attendants that this is under Chatham House rule, which means that you can use information obtained here, but you cannot identify the participants. Okay, go ahead.
Hi, this is Kwon from Bank of Korea. To begin with, I would like to thank you for inviting me to this meeting. I'm very happy to present my paper at this meeting. Today, I'm going to present a paper titled "The Central Bank Digital Currency, Tax Evasion, Inflation Tax, and Central Bank Independence." This paper is co-authored with Seungduck and Jaevin, and the usual disclaimer applies. Recently, central bank digital currency has inspired extensive research among many central banks, international organizations. For example, Bank of Korea, Bank of England, Bank of Canada, PBOC, Riksbank have been actively exploring the possibility of issuing CBDC and launched its pilot program. Bank of Korea also launched its own pilot program. Despite of its relevance to economic activity and economic policy, our understanding about CBDC is very limited. There are many questions that need to be addressed in the perspective of monetary policy, financial stability, and the payment and settlement system. CBDC differ from cash in the sense that all transaction information can be recorded in the digital ledger kept by central bank. Obviously, this transaction information can be shared with the fiscal authority for tax collection. Moreover, CBDC can bear positive or negative interest rate. Paying CBDC implies that payment, clearing, and settlement occur at the same time. Because of each picture, one may argue that the government should introduce CBDC in order to reduce tax evasion and to increase state tax revenue. This paper aims to examine how the introduction of a CBDC can affect welfare in an economy in which cash is used as a medium exchange and tax evasion exists in cash transactions. As long as there are substantial tax evasion-related benefit from the use of cash, CBDC might not completely replace the cash. However, introducing CBDC with the positive interest rate can encourage the bookkeeping trade and reduce the incentive to evade state tax. We answered the following question by constructing a monetary model with the CBDC and tax evasion. First, what is the condition for the coexistence of cash and CBDC? Second, how does introducing CBDC can affect welfare in an economy where tax evasion exists in cash transaction? Third, how does the central bank independence affect this effect of CBDC? The answers are as follows. First, CBDC used as a medium exchange and is when its real rate of return is greater than that of cash. More specifically, if the rate of return on CBDC allowing for sales tax is lower than the rate of return on cash, but higher than that on cash, allowing for sales tax, in that case, each money is used separately. Cash will be used in the tax evaded transaction, and CBDC will be used in tax paid transaction. Second, when the central bank is not independent, that is, the authority can receive security revenue from the central bank for tax collection motivation. In that case, CBDC does not improve welfare more than cash does. When cash is only MOE in the economy and tax evasion occurs, the tax evasion causes a distortion in the relative marginal utility between tax paid and tax evaded transaction. In this economy, welfare can be maximized by substituting a sales tax for inflation tax. The fiscal authority can lower the sales tax rate to zero and receive the synergy revenue from the central bank to finance its expenditure. This policy mix can avoid sales tax evasion and can equalize the net of tax marginal utility of consumption. Both cash and CBDC will be indifferent as an MOE, and this optimal policy follows the Landis principle of optimal taxation. On the other hand, when the central bank is independent, that is, when the fiscal authorities cannot receive synergy revenue from the central bank for tax collection motivation, in this case, introducing CBDC can improve welfare. Since synergy transfer is not available, the fiscal authority should impose sales tax, which causes a distortion in the relative marginal utility between tax evaded and tax paid transaction. The central bank can correct the distortion by paying a strictly positive nominal interest on CBDC. This implies that the central bank makes an implicit transfer from those who evaded tax in non-monetary meeting to those who pay tax in monetary meeting. This paper related to with following literature. Let's skip literature review. Until now, I have delivered the motivation and result of this paper, and from now on, I will explain the model more precisely. The basic structure is based on the Lagos and Light and Williamson 2012. Sorry. Time is discrete and goes forever. In each time, a centralized and competitive market and the decentralized market open sequentially. There are two types of continuum agent, each called buyer and seller, each with unique mass. They live forever and their permanent identity are determined by their roles in the DM. An individual buyer has preference is given by this. Here, where beta is discount factor across period, HT is the labor supply in the CM production. QT is consumption of DM good. An individual seller has following preference. Here, ST is the consumption of CM good, and HT is the labor supply in the DM production. Both buyers and sellers use a linear technology in production. That means one unit of labor is converted into one unit of CM or DM goods. In the DM, pairwise meetings occur between buyers and sellers. Because of anonymity and limited commitment, a medium exchange is necessary for trade or trade to occur. Here, cash and CBDC can serve as an MOE. Each buyer makes a take review pearl. A fraction low of meetings are not monitored, but rest of 1 month low are monitored by the fiscal authority. In the monitored meeting, the fiscal authority imposes a proportional sales tax regardless of MOE type. On the other hand, in a non-monitored meeting, it depends on the MOE type. When buyer use CBDC to pay for good, the fiscal authority can impose sales tax on CBDC transaction. However, when the buyer pay cash in exchange for good, the fiscal authority cannot impose sales tax because it's anonymity. And then tax evasion occurs.
Ohik, a clarifying question on the previous. Yeah. In the DM, what's the difference between CBDC and cash? Like there are different types of goods?
Yes, in the CBDC can be monitored by transaction with CBDC can be shared with the fiscal authority. That means if we in the non-monitored meeting when buyer use CBDC, then fiscal authority can impose sales tax. But in the non-monitored meeting when buyer use cash, then it's anonymity. Because of its anonymity, fiscal authority cannot impose sales tax. Okay.
Okay, but from the point of view of the meeting, either medium of exchange is identical.
Yeah.
Okay, thank you.
Same is your competitive valuation market. Agents adjust their portfolio cash and CBDC. Here, pi t is the real price of cash in terms of CM good, and psi t is the real price of CBDC in terms of CM good. Buyers know whether she will be participating in the monitoring meeting or not. Central bank inject or withdraw money. Government provides public goods such as national defense or social infrastructure. Central bank supplies two types of currency, cash and the CBDC. The stock of cash and CBDC evolves according to following equation. Here, UC is the growth rate of cash. UD is the growth rate of CBDC. As in this type of monetary model, we assume that UC and UD is greater than or equal to beta for existence of monetary equilibria. Central bank budget constraints are given by this. Here, the first term on the right hand side is synergy revenue from cash. The second term is synergy revenue from CBDC. The real value of lump sum transfer from the central bank to the fiscal authority, is denoted by TT, should be less than or equal to total synergy income, ST. The government can collect proportional sales tax from CBDC transaction in non-monetary meeting and from all transactions in monetary meeting, and can receive synergistic income from the central bank to finance its expenditure. Then the government budget constraint is presented by this equation. The first term on the right-hand side is the sales tax revenue in non-monetary meeting. The second term is the sales tax revenue in monetary meeting. Here, X and T represent consumption in non-monetary meeting. X and T represent consumption in monetary meeting. Here is the indicate function for sales tax revenue in non-monetary meeting, because the sales tax can be collected only when CBDC is used as an MOE. If cash is used as an MOE, tax evasion occurs. The sales tax is levied for real value of good traded in the DM, and the seller pays the tax in the next GM. The market timing can be summarized as following this figure. Now consider first the plumber buyer who will be in non-monetary meeting. They choose currency portfolio to consume DM good. Given the take leave offer by buyers, the maximization problem can be represented as follows. Here, sorry. Yeah. Here, sales tax imports for transaction in the non-monetary. Sorry. Here, sales tax is imposed for transaction in the non-monetary meeting if CBDC is used as an MOE, but not if the cash is used. Now, consider the problem of buyer who will be in monetary meeting. Given the buyer's take leave offer, the maximization be represented as follows. Here, sales tax is always imposed as regardless of the MOE type, contrary to previous case. The following results summarize the solution to the above maximization problem. The portfolio choice of buyers depends on the relative rate of return on cash and CBDC. In non-monetary meeting, the rate of return on CBDC allows for sales tax rate, tau. Unlike the one on cash, if the real rate of return on CBDC after tax is lower than that on cash, buyers prefer to use cash as an MOE in transaction because cash allows more consumption of DM good. However, if the real rate of return on CBDC after tax is higher than on cash, buyer prefer to use CBDC as an MOE in transaction because CBDC allows more consumption of DM good. Unlike non-monetary meeting, both CBDC cash transaction pay sales tax in monitored meeting, and hence buyer's choice depends on the relative rate of return on cash and CBDC themselves without considering the sales tax rate. For example, if the real rate of return on CBDC is lower than that on cash, buyer prefer to use cash as an MOE in transactions. Hereafter, we focus on the station equilibria in which their contexts are constant over time. In equilibrium, cash market and CBDC market clearing condition should be satisfied. Also, the government budget constraint, the government and central bank budget constraint hold as follows. Here, the first term on the right-hand side of the government budget constraint is the sales tax revenue from non-monetary meeting. The second term is the sales tax revenue from monetary meeting, and third term is the senior revenue transfer from the central bank. The first term on the right-hand side of the central bank budget constraint is the synergy revenue from cash, and the second term is the synergy revenue from CBDC. Given the equilibrium condition, then there is the five different types of equilibria can be feasible. Summarizing this result gives the following corollary: and cash and CBDC coexist in equilibrium if mu d is less than or equal to mu c, and mu c is less than or equal to 1 plus tau times mu d. Before we move on to the welfare analysis, it is worth examining how the sales tax rate and employees tax rate affect the government's sales tax revenue and the central bank's synergy revenue. We can find out a Laffer curve relationship for sales tax collection as presented in the following lemma. Also, similarly, inflation tax revenue is also a hump-shaped relationship in mu and in mu c and in mu d. Hereafter, we focus solely on equilibrium allocation in which the sales tax revenue increase in the sales tax rate and the synergy decrease in the rate of return on MOE. Now we investigate whether introducing CBDC is beneficial for welfare or not by comparing the equilibrium allocation that can be achieved without and with CBDC. Furthermore, we examine how CBDC affects this comparison. We define the aggregate welfare by adding expected utility across the agent in stationary equilibrium. We consider an economy in which the fiscal authority choose the tax rate tau to support government expenditure G passively, given monetary policy. Then, given this fiscal policy tau, the central bank choose mu d and mu c to maximize welfare. In this respect, the central bank plays the role of planner in this economy. We also define an additional term, zeta, by setting mu d over mu c. Then 1 over zeta minus 1 can be interpreted as an interest on CBDC, which can be positive or negative. Central bank can choose zeta instead of mu d. The central bank independent is defined as t is less than or equal to 0. Given g is equal g is greater than 0, T is equal to 0 in equilibrium, because it's not efficient to collect the sales tax to make transfer from the fiscal authority to central bank. Suppose that CBI is not, the central bank is not required. That is, a transfer from the central bank to the fiscal authority can be strictly positive when cash is used in non-monetary meeting, and in that case, the consolidated government budget constraint is as follows. As long here, the first term is the synergy revenue from non-monetary meeting, and the sum of second term and third term are the synergy from the monitored meeting. The fourth term represents the sales tax revenue. As long as tau is greater than 0, the sum of the third and fourth term is negative. This implies that the loss in the synergy always exceeds the additional sales tax revenue. This is because inflation tax is collected in the CM when currency is issued, whereas sales tax is collected in the DM when currency is used for transaction. There exists a time difference between the point of time in which currency is held by the buyers and the point of time where the currency is used up. Hence, inflation tax can be collected more by the time difference than sales tax, even if they reduce the currency demand to the same extent. However, it's worth mentioning that if the inflation tax is also collected at the same timing with sales tax in the DM, strictly positive sales tax does not cause any loss in the feasibility allocation set in the model. Put differently, the loss in the feasibility results from our assumption on taxation timing. However, this assumption does not affect our main result. We get the following proposition. In a cash-only economy without CBI, the optimal policy is tau is equal to 0 and mu c is greater than 1. In a cash and CBDC economy without CBI, the optimal policy mix is tau is equal to 1, zeta is equal to 1, tau is equal to 0, zeta is equal to 1, and mu c is greater than 1. The allocation achieved by tau equal to 0 is described as point A. Given zeta equal to 1, the first order condition is shown as the 45-degree line because xm is equal to xm when tau is equal to 0. The consolidated government budget constraint indicated by G tau 0 is shown as symmetric around the 45-degree line when tau is 0. At a point A, a social welfare curve indicated by blue curve is tangential to the consolidated government budget constraint.
Okay, just to let you know, time's up and you're eating onto the question time.
Yeah. The optimal policy mix tau equal to 0 and tau mu c is consistent with the Lemnitz principle of optimal taxation. In this case, the of tax minus utility of consumption between monitored and non-monitored meetings are equalized. Now, suppose that CBI is required, that is, synergy revenue transfer from the central bank to the fiscal authority not allowed. In this case, the government budget constraint is represented as follows. The government spending is supported only by the sales tax. And the non-negative synergy condition is given by this equation. In equilibrium, this non-negative synergy condition must bind with equality because consumption in monitored and non-monitored meeting decrease as the synergy revenue increase. In a cash and CBDC economy with CBI, the non-negative synergy condition can be condition with equality can be transformed into following equation. We get the in the CBI in the economy with the CBI, we get the following proposition. In a cash-only economy with the CBI, the optimal monetary policy and monetary and fiscal policy mix is mu c is 1 and tau is greater than 0. However, in a cash and CBDC economy, if G and rho is not so large, the optimal policy mix is zeta is 1 over 1 plus tau, mu c is greater 1, tau is greater than 0. Otherwise, if Gn or Gn rho is so large, the best feasible policy mix is mu d is equal to beta, mu c is greater than 1, and tau is greater than 0. The optimal policy with cash and CBDC improves welfare. In a cash-only economy, so the marginal utility of consumption in non-monitored and monitored meeting cannot be equal with tau, with strict positive tau. In a cash and CBDC economy, paying a strictly positive interest on CBDC can move the allocation from point E to point F if G or rho is not so large. If G or rho is so large, this policy can move the equilibrium allocation from point E to the point at the point between point E and point F, at which welfare is higher. The reason why paying a strictly positive interest on CBDC is welfare improving is that it can correct a distortion in the marginal rate of substitution between non-monitored and monitored transaction. Positive interest on CBDC increases the relative rate of return on CBDC to that of cash. This increases consumption in monitored meeting, which can be described as a counterclockwise rotation of FOC curve in this figure. As a result, it equalizes slope of government spending and the social welfare curve. To conclude, when the central bank is not independent, CBDC does not necessarily improve welfare. However, when central bank is independent, CBDC can improve welfare. In the economy with the CBI, government should impose sales tax, and this generate misalignment in the relative marginal utility between tax evaded and tax paid transaction. CBDC with positive interest can correct the distortion and thus improve welfare. Positive interest on CBDC has an effect of transferring a synergy revenue from transaction which evades sales tax to those who pay it, and thus increasing consumption in tax paid transaction and decreasing consumption in non-tax transaction. In short, tax evasion in the economy with CBI can rationalize the introduction of CBDC with the positive nominal interest for higher welfare. It's over. Thank you for listening to my presentation. Thank you.
Thank you, Huynh. So I think we went already over the question period and over to the next presentations time. So I guess we'll just move on to that. So we're gonna switch gears now and look at the competitors to CBDC. And Ganesh, 25 minutes.
Yep, thank you. Okay, so thank you to Francisco and Bank of Canada for organizing this session. So this is joint work with Richard Lyons. Okay, so as Francisco mentioned, this is a little bit different. So now I'm jumping more into the private alternative to central bank digital currencies, and that's stable coins. So stable coins have surged in the last couple of years, and the largest stable coin at present is Tether. And Tether is essentially surpassed the dollar as the main vehicle currency in the crypto market. So Tether Bitcoin trading has exceeded dollar Bitcoin trading. And given these stable coins are pegged to the dollar, one might ask, why don't you just use the dollar instead to buy Bitcoin? And the main reason stable coins have become popular is because they reduce intermediation costs by being on the blockchain. So an example here from the Bitfinex exchange is that if you want to use dollars, you need to go through a bank, you need to do a bank wire, and those processes can take up to 15 days. Whereas if you use a stable coin, you get essentially high frequency processing on the blockchain. So there are two systems of backing stable coins. The main one is national currency backed, which is every tether in circulation is backed by a dollar reserve. So as you can see from this table, this was snapshot was done a few months back in April. And we can see that Tether is the leading stable coin with about 6.5 billion. And if you look at within a few months, it has now surpassed 10 billion. So it's quite rapid growth. The key point I want to show from this table is that the deviations from the peg for these stable coins are two-sided. So that's something that we will talk about, like why do stable coins trade at a premium or a discount? And essentially we will try to come up with sort of channels for what can generate stablecoin premiums. Okay, so there are two principal questions that we ask. The first question is what keeps stablecoins stable? So many of you know central bankers that central banks typically manage fixed exchange rate regimes through managing foreign reserves. But here we don't have a central bank that's actively intervening in the tether market. So here we propose an alternative theory where private investors are essentially arbitraging deviations from the peg. And the second question we ask is, why is there a two-sided distribution? So if you think about historical examples of fixed exchange rate regimes, say like the peso being pegged to the dollar, you either would expect the peso to be pegged, maintain the peg, or to be trading at a discount if there's some default risk, if the government defaults, for example. Whereas here we tend to see a lot of stablecoin premiums. So that's kind of something that's a bit different to conventional fixed exchange rates, is stablecoins can often trade at a premium with respect to the dollar. Okay, so for the first question, so this arbitrage mechanism is very kind of textbook arbitrage. And the idea is that every tether created is backed by a dollar. So based on this assumption, an investor can deposit $1 with the tether treasury and obtain 1 tether in return, and then sell that tether in the secondary market at a profit. And so what we see on the left-hand side is essentially the flows of tether to the secondary market. And we find that these flows are positive when the tether trades at a premium. So that's basically sort of telling us that when there are net flows of tether from the treasury to the market, that's essentially responding to a tether premium. So there's this kind of evidence that there's an arbitrage mechanism at work. Okay, so essentially you can think of our paper as fitting between two literatures. So there's obviously an enormous literature on exchange rate regimes that focus on fundamentals of exchange rates and sort of central bank interventions. And then you have another series of papers on Bitcoin pricing. And more recently, there's been growing interest in stable coins. And most of the stablecoins work so far has been focusing on the safe haven properties, which I will touch on, and sort of effects of tether on the Bitcoin market. And so here we kind of, our main contribution is trying to connect it to the exchange rates literature. Like, how can we think of stablecoins as a fixed exchange rate regime? And we essentially propose that it's the actions of arbitrageurs that stabilize the peg. Okay, so we'll start off with a model. In the interest of time, I'll only give a verbal description of the model. And the idea of the model is really to just rationalize the stablecoin premiums. And then for the empirical approaches, we have one sort of kind of key result, and that's this migration of Tether from the Omni to Ethereum blockchain. And we exploit this as a type of natural experiment in increasing access to arbitrage trades with the treasury. So that's effectively our main kind of empirical result. And we find that this event led to an increase in the stability of the peg. And so there's this idea that if you increase the efficiency of the arbitrage mechanism, that stabilizes the peg. And then we also give some empirical evidence of stablecoin premiums. Okay, so a brief summary of the model. So the idea of the model is to think of an investor that wants to buy Bitcoin, but they can either use dollars or stable coins as the vehicle currency. So we can think of this kind of, you've got two options, and in equilibrium, the price of the stable coin is such that you're indifferent between these two options. And so in deriving this equilibrium, we find there are three channels through which we can generate stablecoin premiums. The first channel is essentially intermediation costs for dollar transactions. So if we impose that there's some cost of using dollars in buying cryptocurrencies, then that will cause a stablecoin premium. The safe haven effect is more like a risk premium. So if stablecoins tend to appreciate in periods when Ethereum or Bitcoin crashes, then investors will reallocate toward stablecoins in a kind of an extreme episode. And so then there's this idea that stablecoins are safe assets in the crypto space. And a kind of another complementary channel is this latency time idea, that if you use dollars, it can take up to 2 weeks to finalize your transaction, whereas you get high frequency execution of stablecoin transactions, and that can also generate a premium. And to close the model, we have a very simple kind of way of capturing arbitrage, and that is if Tether trades at a premium, then there will be net flows from the treasury to the secondary market to capture arbitrage profits. Okay, so now to the empirics. So we've got a couple of sources that we use. So the advantage of analyzing stable coins is that because they're on the blockchain, you can get an entire history of Tether transactions. So we use two block explorers, and that gives us, for the Tether treasury address, we can get an entire list of transactions the Tether treasury makes. And we can use this data to construct net flows from the treasury to the secondary market. Then the next data set is from Coin API, and they basically give you trade transaction data for basically the entire set of cryptocurrencies from multiple exchanges. And so we use this to get transaction trade prices for stable coins. And we can also get order flow from this as well, because they also have signed trades. Okay, so what do I mean by the flows of Tether to the secondary market? Well, first, we can look at the aggregate balance sheet of Tether. So this graph is plotting the stock of Tether over time, up to about April of this year. And we note that we can decompose the stock of Tether into the stock of Tether available for trading in exchanges and the stock of Tether held by the Treasury. So you can think of this Treasury account as a little bit like a central bank with some foreign reserves. So it's a little bit analogous to that. So to construct the flow measure, we basically take differences. So the difference in total stocks that is attributed to flows from the Treasury to the secondary market is what we are interested in. And then on top of that, changes in the stock can also be due to changes in the Treasury account. And so going back to kind of the motivation, this flow measure is basically what is positive in periods when Tether trades at a premium. So in the horizontal axis of this plot, we have the Tether price. And so at the vertical axis corresponds to the price of 1. And so when Tether trades at a premium, we tend to have positive flows. And then when Tether trades at a discount, we have negative flows. And that's consistent with this arbitrage mechanism where an investor will deposit $1 and sell 1 Tether in the secondary market when Tether trades at a premium.
Ganesh, a clarifying question.
Yes.
How do you distinguish, because all of this data is in the blockchain, right? How do you distinguish between the holdings of the Treasury versus the rest?
Yes, so we have essentially addresses for the Treasury. And so from there, we can kind of get a running balance of the total amount of Tether in circulation, and then whatever residual is left with the Treasury is kind of held in the Treasury account, and whatever that is essentially siphoned off to like other investors, that represents the flows to the secondary market. But essentially, it's using the entire set of transactions based on the Treasury address.
Okay, thanks.
Okay, so we have 3 main empirical tests that we run. So the first one is the one that I mentioned earlier, and that is this event where Tether migrated from the Omni to the Ethereum blockchain. And so we hypothesized that this event led to increased arbitrage trading. And if this arbitrage mechanism is what explains stability of the peg, then an increased ability to arbitrage with the Treasury should increase peg stability. And so the second test is, well, given that we get this arbitrage flow, we should get a stabilizing effect. So back to the example of positive flows to the secondary market when Tether trades at a premium, that's essentially increasing the relative supply of Tether and should push the Tether price down back toward 1. So we want to test whether that's indeed the case. Then a third hypothesis is Tether being used to essentially somewhat manipulate or drive the Bitcoin market? And so there has been work that has suggested that, some previous work. And so we just want to use our flow measure. So again, the flows is a measure of aggregate flows of Tether to the secondary market, and see whether the timing of those flows coincide with changes in crypto prices like Bitcoin. Okay, so this event where Tether migrated to the Ethereum blockchain. So first of all, why did this change happen? Was this a big deal? So it turned out there were lots of reasons why they migrated. One was speed. So that Tether could now be issued on the Ethereum blockchain. It could take advantage of the fact that blocks were mine much faster, and that enables higher frequency arbitrage. There are examples from exchanges which state that the Ethereum blockchain enables a smoother withdrawal and deposit process. And the fact that Tether can now be issued on the Ethereum blockchain means that you now have access to a much bigger network of investors that use that blockchain. And there's also a bigger set of tokens as well. So the Ethereum blockchain is quite unique in that a lot of tokens can be essentially sort of made through smart contracts on the Ethereum blockchain. So there's quite a big set of ERC20 tokens that now Tether can be used as a vehicle currency for. So did this increase the arbitrage mechanism? So using the treasury data, we can look at the number of unique addresses transacting with the treasury each day on the Omni, which was the first blockchain, then Etherscan is the Ethereum blockchain. And we find that once Ethereum blockchain was introduced, we find an increase in the number of unique addresses transacting with the treasury. And so this is kind of our motivating evidence that this did lead to a change in the way the arbitrage mechanism works. So on the Omni blockchain, there was, for most days, there was only one address transacting with the treasury, and that was the Bitfinex exchange. And so that is basically this middle graph figure here is basically the Bitfinex exchange deposits $1, receives a Tether, and then distributes it to exchanges. But now with the introduction of the Ethereum blockchain, we now have multiple exchanges that can transact with the treasury directly. And so that should, we hypothesize, should increase the stability of the peg. Okay, so as a kind of a first pass, we just divide our periods into when the Ethereum blockchain was introduced. And we find that once the Ethereum blockchain was introduced, we find that there was on average much lower deviations, lower volatility, a lower range, and also a lower half-life. So if we think of the half-life as kind of measuring how quickly it reverts back to the peg, then we find that the half-life's reduced from like 6 to 3 days following the Ethereum blockchain. A few other things we find is that if we look at the deposits with the Tether treasury on the Omni versus Ethereum, we find there are a lot more transactions executed on the Ethereum. So 92 per month relative to 16 per month with Omni. This average size of these trades goes down. So there's smaller investors on average. And if we take the time of the deposit with the treasury and we look at the kind of exact transaction price in the secondary market at that time, we can compute kind of an arbitrage spread, which is what they would make if they were to do the arbitrage as soon as they transact with the treasury. And we find these spreads shrink on the Ethereum. And that's consistent with the story where now that you have a lot more investors arbitraging with the treasury, these average spreads should go down. So that's consistent. So in terms of robustness, obviously, the Ethereum blockchain migration happened in April 2019. You know, a lot of other factors could be at play. Maybe there was an increased trend of liquidity on exchanges. There's some technological changes that occurred that might have led to increased peg stability independent of the arbitrage mechanism. And so what we do is we take a control group of stable coins that did not have this migration and have similar properties of being backed 1-for-1 with the dollar. And the critical thing is that this control group actually was always on the Ethereum blockchain. And so you have Tether migrating from Omni to Ethereum. And so our design is basically trying to get a causal effect for this migration from Omni to Ethereum. And so using this difference in difference design, we note that even with this control group, we find an efficiency gain. So the average absolute deviation decline was about 60 basis points in the post period. But if we sort of control for using the difference in difference, we still get about a 45 basis point efficiency gain. So there is this idea that migrating from the Omni to Ethereum blockchain increased efficiency of the peg. So we have some additional tests in the paper that I won't go through that kind of tries to get more into whether it's this arbitrage mechanism with the treasury. So I guess one kind of thing I won't go into a lot of detail is that even if you buy that there's an efficiency gain, one could still argue that perhaps it's due to a different type of arbitrage, maybe indirect arbitrage, because it's easier to arbitrage price differences in exchanges as opposed to arbitrage with the treasury. And so we try to use an IV approach to kind of look precisely at the instrumenting for the number of addresses transacting with the treasury, and we find using that approach that there is an effect of increased transactions with the treasury leading to increased stability. But that's still yes, something that we have been working on as an additional test. Okay, so the second test is thinking about the stabilizing arbitrage flows. So here we use local projections, and we are essentially projecting the change in the tether price at different horizons on the flow of tether from the treasury to the secondary market. And so here we hypothesize that an increase in the flow, so positive flow, is increasing supply of tether in the secondary market, and so it should lower prices. And that's what we find. So our estimates suggest that a 1 standard deviation change in flows leads to about a 10 basis point change in the tether price. And our third hypothesis is there some timing of tether issuances that coincides with an appreciation of Bitcoin? So we find that based on our flow measure, we find no effects. So I guess this is supportive evidence that flows tend to be more driven by arbitrage as opposed to trying to time issuances into the Bitcoin market. However, again, this is based on our approach of using aggregate flows of tether to the secondary market. Okay, so some last things we do. So going back to the model, so the model's main idea was to think about what caused stablecoin premiums. So here we just offer some kind of illustrative empirical evidence. 2 fundamentals of stablecoin deviation. So order flow, we find significant effects, and we find the volatility of Bitcoin when it goes up tends to lead to tether premiums. And so for the safe haven effect, we find that if you have a cryptocurrency factor, that the stable coins tend to have negative co-movement with this factor. And we also look at the March 12th period. So many of you might be familiar that on March 12th, there was a really big crash of Bitcoin. And if we look at the stable coin premiums, they were really generally quite high during this period. And so that's kind of indicative of the safe haven effect. And for discounts, we find something similar to a peso crisis for Tether in October 2018. And this was essentially a case where investors thought Tether was under collateralized and did not have sufficient reserves. And this led to significant discounts and significant rise in bid-ask spreads as well. Okay, so to conclude, the couple of things that we did, we identified an arbitrage mechanism through which investors transacted with the tether treasury, and this is what is responsible for maintaining the peg. And to identify that, our main event that we used was this migration of tether from the Omni to Ethereum blockchain that we hypothesized and showed led to an increase in peg efficiency. And for why there's a two-sided distribution, we looked at stablecoin premiums due to a lower intermediation cost because it's on the blockchain, providing a sort of a safe asset in the crypto world and a lower latency time of transactions. And we also showed some evidence of why stablecoins trade at premiums sort of in risk-off events. And I guess to conclude as well, given this session is on central bank digital currency, I mean, obviously, I can't speak a lot to that, but I think our paper can perhaps be viewed as something more applicable to what would make Libra, say, peg to the dollar. So if Libra does go through, I imagine the mechanisms through which Libra pegs to the dollar would be very similar, but obviously at a much kind of grander scale. But yeah, so thank you, and look forward to any questions.
Thank you, Ganesh. This was great. Okay, so open the floor to any questions from attendees. Okay, so I have a couple questions on my side, Ganesh. First, in terms of the reports that the Treasury was not actually safeguarding the US dollar backing of Tether, right? So that must be really massive in your econometric analysis, because in the margin that arbitraging might matter less if you reserve assets of the stable coin are, as it was reported, Bitcoin themselves, right? So that's one question. Probably you can address on how the mechanism that the estimates that you got might be affected by that.
Yes, so there are reports that Tether is under collateralized, but I guess our view on that is, to our knowledge, we still take Tether's statement that they are fully backed, and when there are reports that they're underbacked, they talk about this term of cash or cash equivalents, and so they say Tether is like 74% backed based on cash or cash equivalents, but that could be essentially like a terminology distinction where if you allow less liquid assets, then they are fully backed, but they don't have all of their reserves in cash or cash equivalents. So I guess the other thing is, in terms of that report itself, we didn't find an effect on the Tether price. So in some sense, a market reaction was essentially suggested that they did not price in an increased risk when that report came out. But I mean, in general, I guess a lot of that speculation on Tether happened in the pre-Ethereum blockchain period. So I guess the main results of the paper in finding an increase in peg efficiency, we also attribute that to the when the introduction of Ethereum blockchain. And the advantage of that event was that it meant other investors could arbitrage deviations as opposed to just Bitfinex, which was also the subject of some current litigation. So we are essentially finding that there's been a trend increase in peg efficiency, and that is because they've kind of democratized this arbitrage process. But I agree that we are, as kind of an implicit assumption, taking as given that they are backed 1-for-1 with dollar reserves, whether they are all cash or cash equivalents, or maybe they have some interest-bearing assets as well. We don't have knowledge of that.
Okay. So there's another question from Martin Van Noort. So do you control in your estimates for periods when direct redemption of fiat from Tether was difficult or even halted in 2018? And if you can just take 1 minute to respond, that'd be great.
Okay. So this is, yeah. So there was that week or so where Tether traded at a big discount in October 2018. So we do control for that, and we find that our diff results on like the increased beg efficiency don't change. So yes, so it's not driven by that week in October where there was a big discount.
Okay, perfect. Thank you, Ganesh. So let's move on to the last paper, and this will be even broader than the previous one. Tarik, on vertically disintegrated platforms. 25 minutes.
All right, so thank you very much, Francisco. Thank you for the organizers to include this paper in this very exciting program. As you mentioned, I think we are covering different aspects of digital currencies and central bank digital currencies. So this is very exciting. So this is joint work with Christoph Aymanns and Mathias Dewatripont. So the paper is entitled Vertically Disintegrated Platforms. And really the idea is to study if and how distributed ledger technologies can improve user welfare digital payments. And so the motivation here is really to look at, for example, over the past decades, payment platforms have become paramount to the organization of our digital economy. However, there's a number of studies that have pointed out that several barriers still exist to the full adoption of digital mediums of payments. So this is an example from a study by Lee, McAndrews, and Wang in GME last year, who documented the slow rate of payment card adoption in the US, which was particularly important as we look down the income ladder. And so in this same paper, the authors argue for two main barriers and two main reasons why we have this slow rate of adoption. So the first one is payment platform market power, and the second one is specific deterrent cost to particular types of users in this economy. And so in fact, if you consider credit card payment systems, you see that in Europe, Visa and MasterCard take up more than 90% of the European market. And in credit card payments, typically what you see is that these platforms tend to underprice the consumer side, and they do it at the expense of the merchants. So these mechanisms and these barriers have been here for a while, and in particular the analysis on these type of economic forces goes back to a model built by Jean-Charles Rocher and Jean Tirole back in 2002 when they introduced the idea of multi-sided platforms. And basically what they showed there was that when you think about platforms, and in particular if you think about two-sided platforms, there are typically two features you should take into account. The first is the network effects that are present on those platforms because they create value by allowing different types of actors to interact. So the more they are on the platform, the more value other people derive from it. And so we have natural monopoly conditions. And then the second part is the heterogeneous demand that is present on these multi-sided platforms, which typically will generate this asymmetric price structure where one side will be overcharged in order to subsidize the participation of the other side. So if you think of credit card payment, this is typically what happens when merchants have to pay more per transaction than buyers. Now, governments in general and all over the world have tried to address these issues, these barriers, and tried to limit abuses from platform monopolies in different ways. So they've intervened by putting cap on fees. They've also tried to promote adoption by forcing acceptance of cards. So that's typically an example for US cab drivers. But in general, the debates regarding which policy is the best fix to this issue of user welfare and payment platform remains open. Some of the latest decisions have actually gone in favor of the platform. So that's an example of the recent Supreme Court's decision in the US, which sided with American Express in the case of market power abuse over merchants. So it is in this context that we consider distributed ledger technologies. And so our view here is, and as it was discussed yesterday during the keynote, is one of the key opportunities brought by distributed ledger technology is this capacity to allow groups of agents to coordinate on a common state of the world without the need of intermediaries. So here what we mean, what we have in mind by intermediaries would be those payment card companies. And so, if you think about Bitcoin, typically what you think of is a situation in which someone submits a transaction, and the processing of this transaction is not done by let's say one major platform entity, but it's done through a network of agents who compete to produce the service. And so this particular aspect has brought some scholars to speculate about the impact on consumer welfare. So this is typically the case of Kristen Catalini and Catherine Tucker, back when Kristen Catalini was at MIT and Catherine Tucker is still at MIT. And they said in a paper in 2018 that in theory, blockchain technology can be used to overcome the coordination challenges that otherwise lead network effects to be a source of market power. And in the end, the same reasoning, I mean, Kristen Catalini went on to be one of the founders of the Libra project, but the same reasoning in the end sits with the Libra white paper, and this idea that this technology, this distributed ledger technology, can help improve financial inclusion and tremendously reduce the cost of payment services. And so to finish on this overall motivation, we also need to mention the increase in interest by central bankers, and in particular, who are getting more and more involved with the technology and its potential economic impact. So here is a quote from recently this year by Christine Lagarde, who said, "Innovation in the area of payments is racing ahead in response to urgent demand for quicker and cheaper payments. The ECB wants to play an active role in this field of cryptocurrency rather than just acting as observer of a changing world." So it is within this whole motivation and context that we enter with this paper, and what we basically want to do with this paper is to test the proposition that Catalini and Tucker have put forward. So we want to understand what is the impact of distributed ledger technology on user welfare in payment systems. And the way we want to address this is by modeling this phenomenon through the concept of vertical disintegration. So in traditional payment platforms, you have buyers and sellers who coordinate on the platform to transact, but this platform typically owns the whole infrastructure and has full control over the prices that are going to be charged over these users. In contrast, if you think about Bitcoin, what would typically happen is that Bitcoin does not own any infrastructure. If you think about Bitcoin as a payment system, what you realize is that the provisioning of the service is provided by a market of processors who compete to process the transactions between buyers and sellers. The price now is determined in the market clearing mechanism between the processors and the users. All right. So really, you can think on the right-hand side, and I will elaborate a little bit more on that. But on the right-hand side, you can think of an extreme as Bitcoin, and on the left-hand side, you can think of an extreme as Visa, MasterCard, and American Express. And so ultimately, our question is, what are the welfare implications of vertical disintegration? And we address this question by building a model where we do comparative statistics between a case where we have what we call a VIP, a vertically integrated platform. So that's the traditional setup. And then we have a VDP, a vertically disintegrated platform. Let me quickly go through the model. So the model we construct is shamefully simple. It boils down to an extension of the classic two-sided platform payment model of Rocher and Tirole. And what we do there is we introduce a market for processing user transactions. So users in our setup are buyers and sellers who extract utility from interacting on the platform. They also have to pay a transaction fee that is specific to their types. So buyers pay AB per transactions and sellers pay AS per transactions. And now we have this new agent class that comes in that is going to be these processors who make profit by processing transactions. For each transaction a processor processes, he or she earns a share 1 minus T of the aggregate fee price P, which is the sum of AB and AS, where T is going to be a tax that is set by the platform. Each of these processors has a cost that is driven by their own processing technology, and it's drawn from the known distribution. Finally, we have this platform which allows interactions between buyers, sellers, and processors, and generate revenues by charging a tax on each transaction. So it's this T that we saw before. So the platform maximizes profits via two variables, with the access of two variables. On the one hand, we have the tax that is charged on the transaction, and we have the split, so the price structure definition between the transaction fee that is going to be paid by the amount that is going to be paid by the buyer and the amount that is going to be paid by the seller. And so this split, this asymmetric, this price structure variable is going to be Z here. And so the profit of the platform is determined by the revenue from this tax being charged and the cost C, which is fixed here, and it represents the cost of establishing and maintaining the platform. At the market level, our welfare analysis will be focused on the participation, so the number of buyers and the number of sellers that join the platform. And the market clearing mechanism that we have here is determined by P, the aggregate price, which basically makes the demand from users meet the supply from the processors. All right, so that's for the VDP, and now the VIP is going to be, a reduction of the VDP that is very close to the original Roche-Tirol model. So in this case here, users are going to be the same as before, and now processors don't exist anymore. And what we assume basically is that the platform integrates the full technology infrastructure that was previously distributed among the processors. So the technology is the same, it's just that now it's being integrated inside the platform. So the cost distribution is the same as before, but now the platform has full knowledge about the costs that are being incurred. The difference is also that the platform can fully control both price level P and the price structure Z. The platform collects all the revenue from transaction fees, and similar to before, it faces an additional cost of establishing and maintaining the platform C. The only trick that we add here, and I will comment on that in the last part of the result, is at some point we will allow for this cost of establishing the platform to be dependent upon the total transaction volumes, so the activity within the platform. So I will explain that a little bit later. And now at the market level, we do not have any market clearing mechanism, and all the pricing power is devoted to the platform, to the VIP platform. So that's our model. And now we move on to the results. So our plan for the result is to compare two monopoly settings. So on one hand, we have a world where we have a VIP monopoly. And then on the other hand, we have a world in which we have a VDP monopoly. So the reason why we focus on monopoly cases is in order to maximize users' benefits from network effects. So what we want to do here is really focus on the precise welfare implication of disintegration in the extreme case where there is absolutely no platform competition. And so users don't have to have a loss if ever a buyer has a seller that is on another platform. So we abstract from all this and we take an extreme case where it's only monopoly platforms and we focus on the disintegration effect. And so our results plan strategy is to first focus on the effect of disintegration over price structure, and then move on to a welfare analysis where we'll start with an oversimplified case with exogenous tax and no problem of cost structure. And what we will do next is add ingredients incrementally in order to reach a more realistic level of results and modeling by the end of the analysis. All right, so for the price structure, what's important to know is that the price structure strategy of multi-sided platform has been widely analyzed in the literature. A major result is that when we have different sides which exhibit different elasticities of demand, so basically they value the interaction of the other one differently, it is efficient for the platform to charge each side differently. So in our case, recall that the VIP maximizes profit by setting the price structure and the price level, whereas the VDP only has control over Z, the price structure, because the price level P is set by the market through the market of processors. However, our first result is going to be that given the same price level P for both platforms models achieve the same price structure Z. And this simply results from the fact that in the VDP, the supply from processors is completely independent. So the platform can always increase its profit by raising the level of demand at any price level. And so in the end, both platforms will converge to the same price structure that maximizes demand. All right, so why is this result relevant? So we believe it's relevant for two reasons. First, on our side, it allows us to focus the welfare analysis only on price levels because now we know that the price structure is going to be similar between the two models. And the second reason is that this result shows that previous knowledge about multi-sided platforms directly apply to the case of a disintegrated platform analysis. In particular, one of the important results was the adapted learner formula, which determines the efficient pricing for multiple sides still holds for VDP. And so this will help us have a welfare judgment on the design of current VDP applications that we will have in the next section. So now we can, armed with this price structure information, we can move to our first welfare analysis. And as I said here, we start very simple. So we assume that both platform models have the exact same cost structure, and that for the case of the VDP, the tax is given exogenously. So what we find in this case is that welfare under the VDP, so prices for users under the VDP, will dominate the case of the integrated traditional platforms if the tax set by the VDP is lower than a benchmark tax TI. And this benchmark tax TI is obtained from the following analysis. So first note that the tax that is charged by the platform influences the total supply. Lower taxes increase the supply curve because it brings more processors. And for a given price set by, so what you see here is that for a given price set by the VIP, which we call PI, we can always find a tax that the VDP should set in order to replicate the price of the VIP PI. And so that's the tax that we call TI. So once we find this tax TI, once it's determined, we know that any tax set by the VDP that is lower than this TI will yield a higher supply, thereby lowering the prices, resulting in high welfare under the VDP. All right, this is the sketch of the proof. Next thing we do is we endogenize this tax. So now the processor, the VDP is going to decide and is going to maximize its profit while deciding on the tax. And so what we find is that if the VDP is left to choose the tax that maximizes its profit, welfare under the VDP will be lower than welfare under the VIP. And the reason for this stems from the information disadvantage of this integration. So the idea here is simply that the VDP does not observe marginal cost from processors because it does not possess this information, because it belongs to the private information of processors. And because of the linear price nature of the tax, it cannot extract all the surplus from all those processors. In contrast, because the VIP owns the technology, it fully observes this cost and it can perfectly price discriminate there. So the VDP will have to compensate this disadvantage by imposing a tax that ends up being higher than the benchmark tax TI, which was supposed to replicate the VIP result. And so in the end, the welfare under the VDP will be lower than the welfare under the VIP. All right, so we can now combine these two information, the previous result and this one, and conduct a policy recommendation. And so a corollary of these two results is that there is an upper limit that can be set by the policymakers or the regulators on the taxing capacity of the VDP, such that taxes charged on the processors cannot be higher than TI. And if ever that is the case, then we know that welfare under the regulated VDP will always dominate the VIP outcome. So in the end, here to draw a parallel, in the end, this idea is very similar to labor economics, because the VDP in the end acts as a monopsonist in the market for processors. Hence, this result acts pretty much like a minimum wage intervention in labor markets. All right, so finally, the last result that I want to show is a result in which, as I said, we destroy the other assumption, which is related to the cost faced by the VIP. And so what we say here is we allow for the cost structure of the integrated platform to be a function of the total transaction volumes on the platform. And not surprisingly, in this case, we find that if the growth rate becomes significant, welfare under the VDP will dominate even without any intervention on its taxing capacity. And in the end, this result is simply driven by the fact that as costs increase, the VIP will have to reduce demand by increasing prices. This will effectively increase the benchmark tax, the imputed benchmark tax TI, which will become larger than the endogenous tax set by the VDP. And the reason for this is that the endogenous tax set by the VDP remains constant because changes in demand are always absorbed by the processors by virtue of the disintegration. So let me, if I have, I'll take 2 minutes to just explain a little bit why we play around with this idea of cost and microfound it with real cases. So in payment system, we have 2 different types of cost structures, even if we are in a VIP setting, which is typically what we have when we discuss open loop versus closed loop system. So in open loop systems like Visa and MasterCard, these payment platforms partially rely on the infrastructure of a system that is already in place. So here would be like the banking system. Accounts are not held directly by the platform, but they are held by banks. And the platform mainly boils down to a network which passes messages between accounts. And so such architecture is typically capital light. And in this case, we can assume that the cost structure between a disintegrated platform and such a VIP platform would be quite similar. So we would correspond to the assumption that were made in the first three results. So we can contrast this situation with a closed loop system where the company owns the full infrastructure and all the accounts and all the maintenance of the accounts that are associated with each participant. And this would typically be the case for American Express. So this business model compared to the open loop system is much more capital heavy. In particular, all the costs associated with adapting to the demand and the flows is directly borne by the platform. And so in this case here, we can assume that here we have a case where the cost structure borne by the platform is a function of the demand. And then therefore the last result that we saw would apply in the case of American Express and would less apply to the case of an open loop system. All right, I hope that was clear. Okay, so the last thing I want to do is use the framework we've established in the result and think about deriving welfare implications and recommendations from current applications. So the first ones we can address is typically systems like design systems like Bitcoin and Ethereum. But in this case, one important caveat that I need to push is that our approach is interested in the design choices of the payment platform. So here we completely abstract from all the tokenization aspect of Bitcoin and Ethereum. So in the end, you can think of, yes?
4 minutes.
Okay, good. So in the end, you can think of, so here we only focus on, so here we only focus on the payment dimension and not the token dimension. And my take would be that the payment dimension is even more relevant whenever we'll start talking about stablecoins, which we haven't yet. But in the case of Bitcoin and Ethereum, from our perspective, there are two things we can say. First, this platform can be seen as zero tax platforms. Nothing is charged on the processors by the platform, and there is no revenue derived from transactions for the platform. So according to our result, these very low taxes, i.e. zero, are good for welfare. However, these platforms have a very precise price structure design, which basically makes the buyer pay the full transaction fee. So in our model, that would boil down to Z being equal to P over 2. And this particular design would fail to capture heterogeneous demand profiles. So by virtue of our result on price structure and the literature, the vast literature on multi-sided platforms, we know that platforms increase welfare by setting the price structure according to the elasticities of demand from both buyers and sellers. As a result here, Bitcoin and Ethereum, the design of Bitcoin and Ethereum would fail to account for the potential multi-sidedness of payments, which may ultimately harm welfare and in the end constitute a major barrier for global adoption of those platforms. And the last thing I would like to discuss here is the implications of our result, and I think that's how we can join in the other papers from this session, is the implications of our result for debates about central bank digital platforms and central bank digital currencies. So according to our results and according to our framework, a CBDC that would be supported by a regulated VDP governance model would be welfare maximizing for two reasons. First, it would ensure the capability to adjust price structure efficiently between the different sides, the buyers and the sellers, if we're in a retail CBDC setting. But it would also be able to control the tax levels that are being charged on processors. And by keeping those two dimensions alive, according to our framework, that would be a welfare maximizing design. So such solution would allow governments to implement central bank digital money and other payment solutions without having to bear the traditional enormous investment costs and maintenance efforts that come with integrated platforms. I'm thinking typically of Target 2, for example. All right, so I'm almost done. Let me conclude. So our hope with this paper is really to broaden the debate about platform market power and consumer welfare in payments, in particular in this setting that has been made possible by the introduction of distributed ledger technology, because what we can do now is study a technologically driven market solution to the issue of market power in presence of network effects. And so we study that through the concept of vertically disintegrated platforms. And what we find is that the desirability of this integration is determined by, on the one hand, the cost structure faced by the integrated solution, and then on the other hand, the market conditions for processors and the taxing capacity of the platform in the disintegrated case. We also find that the price structure results from the traditional platform literature apply in the case of disintegrated platforms, suggesting that they be taken into account as well in future application of platforms, typically such as central bank digital currency. So we lastly showed that our framework can generate simple welfare applications for current applications, such as the design of Bitcoin and Ethereum, but also provide guidelines and suggestions for future regulation and design policies, including central bank digital currencies. All right, so let me stop here. Thank you very much, everyone, for your attention, and I look forward to any comment or feedback you may have.
Thank you, Tarik. That was really good. So open the floor for any questions from attendees, other panelists. Okay, I do have a few questions, Tarik, on the proposal of the on how policymakers can encourage vertically disintegrated platforms. Probably I didn't follow exactly. Is where would the interventions? Sorry, where would the interventions be to encourage platforms not to organize themselves as integrated, like traditional integrated platforms?
I see. So the policy intervention that that our results suggest is on the taxing capacity of the disintegrated solution. So what we say is that there should be a limit in how much the platform can charge the processors for the transactions they process, which is similar to a minimum wage intervention in a monopolist market. I think what your question is because this is so the whole conversation I've had in this presentation is about consumer welfare. So here we don't account for the private incentives of platform makers to choose between the integrated solution and the disintegrated solution.
Exactly.
I didn't do it. Yeah, and I didn't. So in the paper, we actually have a section on that. And what we show is that, which suggests when one should want to have policy intervention or not, as a function of when the welfare from users and the incentives from platform makers align. And so what we show is that there is a spectrum, and this spectrum is a function of basically the pricing capacity and the cost structure that is faced by the platform. So as a function of the functional form of the cost structure, as a function of, for example, the total demand, the total transaction volume that is faced by the platform will determine in which areas the platform will have an incentive to become disintegrated, because once you disintegrate, there's a lot of cost that you don't have to bear anymore, right? It's like when you move from closed loop to open loop. And so that will be one of the major trigger in the incentives from the platform to decide which design which integration or disintegration option they want to use.
Okay, so I guess in terms of because I can see how our own CBDC we choose to make it disintegrated, that's fine. Mm-hmm. But I guess the competition policy is complicated on incentivizing an integrated one to become disintegrated if we were able to compute their cost structure and other relevant statistics, right? I think that was kind of the angle of my question.
I understand. So right. So I would need to think about it more precisely, but I can typically come back to you after trying to map your question to this particular new section that we have in the paper, where we look at the ingredients that you need in the cost structure to incentivize platforms to move from an integrated case to a disintegrated case. Right, and I think in the end, it really boils down to this idea of, if you compare a closed loop system to an open loop system, the closed loop system faces these economies of scales, and they may want to move in a disintegrated setting because they would flush away all these costs.
Right. Yeah. Okay. Yeah, that'd be interesting, because I mean, not only on the CBDC discussion, but there's also discussions about how CBDCs might be platforms for other platforms, right?
Right.
For processing payments, for example, fast payment systems, right?
Yeah, definitely.
So that's I guess an interesting question to start thinking about.
Thank you.
Okay. Any other question from anyone? I know we're a bit over time, but I just wanted to open the floor for any paper, any comments, general. Okay, if not, I just wanted to thank all of the presenters for their presentations, really good, and hope to see you in other sessions on, I think there's another one tomorrow on CBDC and crypto. Perfect, thank you everyone.